everyone. It's Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the market insights for Friday, February 5th. There's a big mystery in the financial world. Why is the output of oil not responding to the fall in the price? The fall in price is a signal that supply exceeds demand. Producers usually respond by cutting back on production. That's the idea behind Saudi Arabia's strategy of keeping production high. They want to drive the highest priced producers, namely the U.S. shale oil drillers, out of business. Then global production will fall, supply and demand will balance again, and the price can go back up. The conundrum is clear. The number of oil rigs in the U.S., the yellow line in this graph, is down almost 70% from the peak. More than 42 oil drilling companies have filed for bankruptcy as the price of oil, the blue line, collapsed. Yet, even with 2 out of 3 oil rigs sidelined, production has come off only slightly, and it's rising once again. U.S. output last week was down only 4% from the peak. So the amount of oil that each well is producing has almost tripled, from around 6,200 barrels a day per well to 18,500 barrels per day per well. The reason is that, first, producers have shut down their least productive wells and kept pumping their more productive wells. Secondly, technology is coming to the rescue. Oil producers are using new techniques and new technology to boost their output and keep their wells competitive. Now, there's some even more dramatic news. Bloomberg Intelligence, an analytical service of Bloomberg News, calculates that some of the shale producers are still profitable with crude prices below $30 a barrel, some as low as $22, $52 a barrel. Moreover, that's for wells that are already completed. Oil companies have a backlog of over 4,000 wells that have been drilled but haven't yet been completed. Drilling is very expensive. Once it's already drilled, finishing it with the above-mentioned new techniques and new technology to increase the production isn't so expensive. Bloomberg Intelligence found that in many areas, it's still economic to complete these wells at oil below $30 a barrel. In some cases, at prices as low as $14 a barrel. The bottom line is that the supply of oil is probably less responsive to low prices than everyone had thought. It's not likely to bounce back significantly anytime soon, unless there's some major disruption to supplies out of the Middle East or OPEC. In other words, Saudi Arabia changes its tactics. Now, the impact of continued low or even lower oil prices on the FX market would be among the following. 1. The oil currencies, the Canadian dollar, Norwegian krone, Mexican ruble, Mexican peso, and Russian ruble, are likely to come under continued downward pressure. The other commodity currencies, such as the Australian dollar and New Zealand dollar, may languish alongside them, although, of course, they're more correlated with other commodity prices. 2. Global inflation is likely to remain lower for longer than central banks had anticipated. Combined with a recent move by the Bank of Japan into negative interest rates, this means we could be in for another round of competitive interest rate cuts, which in effect means a currency war. The big question is, will this low level of global inflation cause the Fed to change its plans? No one can answer that yet, but it needs watching. The monetary policy divergence theme is based on the idea that the Fed tightens while the ECB loosens. But if the Fed isn't tightening, then policy won't diverge as much as expected, and eurodollar can recover somewhat further. And if the Fed were to start loosening too, that would mean a big change in the market scenario for the dollar and a much weaker U.S. currency. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.